Okay, so so when you're using the allowance method, if you actually have an account call you and tell you that they're not going to pay their bill after you've done your allowance entry at the beginning of the year, you still do an entry to record that person not paying their bill. Okay. So this example here is showing that. So on March 1st, 2023, Hampson Furniture writes off $500 owed by R.A. War. Where? So the entry to record the write-off is they're going to debit allowance for doubtful accounts to remove the money from that account, and they're going to credit accounts receivable. So they're saying that the money's no longer doubtful, it's going to go bad. It actually went bad. So they're writing it off. They're taking it out of accounts receivable. It's already part of bad debt expense because we put it into bad debt when we did the allowance at the beginning of the year. Okay. All right, the next slide says, on July 1, R.A. War pays the $500 amount that Hampson Furniture had written off on March 1. So if an account decides to pay you after you've written it off, it's a two-step process. 1, you have to put the money back, and 2, you have to post the payment, okay? So July 1, put the money back. You're going to debit accounts receivable, $500 to put the money back to the customer's account. And then you're going to credit allowance for doubtful accounts, $500. That is the put back, putting the money back to the customer's account. Then you're going to debit cash for $500, the amount that they are paying you. And you're going to credit accounts receivable $500 to clear out their account because they actually paid you, okay? So this is if they call it a recovery of an uncollectible account. So if an account you've already written off pays you, you 1, put it back, and then 2, post the payment, all right? That's the put back and the payment. All right, so let's go down to the next slide. Okay, so this is information that is just information for you. You do not need to know this in the sense that you are not going to have this on an exam. You are not going to have this on, oh, you know what? I need to go back just a second. I forgot to record that part about the put back, I think. Oh, no, I did record it. Okay, good. All right, sometimes companies don't want to go through the time and energy to collect accounts receivables. It takes a lot of time to collect money from customers. So sometimes what happens is companies will sell their accounts receivable to another company, and they'll pay a percentage to sell it. But what happens is that they sell their accounts receivable to this other company, and then that other company pays them their money up front. So while they might be paying a commission for the company to buy their accounts receivable, they get all their money right away, and then they could do what they need to do with their money. They don't have to pay someone to collect the money. They don't have to wait for the money. They have their money right away. And sometimes you might see this happen as a consumer, in that maybe you have a home loan or a car loan or something with a company, and all of a sudden you get a letter in the mail and it says, hi, you have been making your payments to Chase Bank, and your loan has now been transferred to Wells Fargo Bank. Nothing has changed with your loan. You are just making your payment to a new location or a new company. Here's the information. So for the consumer, there's no change. But what basically had happened in that instance is Chase Bank sold their receivables to Wells Fargo, and Chase Bank probably paid a percentage of money in order for Wells Fargo to take those accounts. But now Chase has their money, they've been paid in full, and they don't have to collect it. So they call this factoring. So this is an example here. Assume that Herderon Furniture factors $600,000 of receivables to Federal Factors. Federal Factors assesses a service charge of 2% of the amount of receivables sold. The journal entry to record the sale is as follows. Now, you're not going to have to do this, okay? You will not be doing any entry like this. This is just for you to see as an example, okay? So they're going to take $600,000 times 2%. That's going to give them $12,000. That's the amount of fee that they're paying. So they're going to debit cash, $588,000, which is $600,000 minus $12,000. They're going to debit service charge expense $12,000, and then they're going to credit accounts receivable $600,000. And so someone might look at this and go, wow, they're going to pay $12,000 in order to get their money. But the reality is that they couldn't hire a collections person, pay them a salary, pay them benefits and all that for $12,000. So this is actually cheaper for the company to do this. And now they've passed on that debt or that receivable to somebody else. And now that other company is going to collect from the customers and they don't have to worry about it anymore. So you will not be doing that in any problems, but it's just information for you to be aware of when we're looking at accounts receivable. It is something that is, it's not done like for small companies and stuff a lot. It's really done for like big banks and things like that do it a lot. Okay. This is just talking about credit card sales. We're not going to be covering credit card sales at all, so I'm not going to worry about that. And I think we're going to end with doing problem 8.7. And so I'm going to stop this and do a new recording.